I guess like money flow, ma'am.
It is money
Incomes
flow.
and expenses income and expenses are matched with each other.
Fine. Yes. Income and expenditures. Fine. Money involvement of money. Then
Basically, government fiscal structure.
okay, part of it. Then
Exchange of funds.
funds. Okay. See, when we talk about a financial system, just like a body has a nervous system, wherein the blood is supplied to each and every part of the body so that they can function properly. The same way this financial system works. So this financial system is a kind of a nervous system for the country's economy. So if the nation's economy has to develop, your financial system has to be highly effective and efficient. They have to perform very nicely. Then only we can call it as a healthy financial system of the country, and ultimately leading to economic development of the country. So if you don't have a strong financial system in your country, obviously the country economic status will never go to a higher level. So that is very, very important here. Effective and efficient financial system is necessary so that the country's economy also develop. As I told you, it is a nervous system of the country's economy. So without this financial system, your economy cannot flourish, your economy cannot operate. So what kind of things are there in this financial system? What all things we can call as financial system? Let us try to understand them. So these are the four major components of financial system in our country. Okay, so these are the four things which almost rule or which almost support the economic development of our country. So we have financial markets, we have financial institutions, we have financial instruments, and financial services. So financial markets, I guess you already know it.
Yes,
Kindly,
ma'am.
somebody's mic is on, please mute it. Okay, fine. So these are four major components of financial systems of of our country, which actually facilitate the economic development. So this financial system actually facilitates the economy by funding them, by investing in them, and helping for the development of the economy here. So economy itself or government itself cannot do everything. They need funds, and those funds come from these four sources for the government also, as well as big projects also. So whenever these financial institutions or anybody, they invest in huge projects or anything, ultimately it is the development of the country only, because it creates employment, it creates products which can be exported into the other countries. It can create bigger opportunities in the world market, right? So there are many facilities which you get when we talk about these four components of the financial system of our country. So our economy cannot develop at all if there is no well developed financial system. If there is no well developed financial system, our country cannot function properly, and especially when the competition is very high in the world markets. Okay, so to meet and to stay with the competition, you should have a strong, healthy, well developed financial system. Excuse me. Hello, madam, class 8 మాట్లాడుతుంటారు. Hello, sorry. Any country's economy, it will only function properly when there is a well-developed financial systems. So this word system means it runs on certain rules and regulations. Okay, so every single component of this financial system, they are also interconnected with each other very, very closely. So if this four areas of the country perform better, ultimately you can easily achieve that 5 trillion economy dream of our government, present government. So that is very, very important. So that is the reason why the banking system is being strengthened due to mergers and getting 2-3 banks together and making bigger banks. So it is facilitating somewhere and supporting that development of towards the 5 trillion economy. So these are certain benefits what you get having a strong financial systems. So what are these financial markets? Let us try to understand one by one. So financial markets basically are your investments, especially wherein funds or savings can be transferred from one section to another section of the financial system. So we have actually two things here. One is primary market and secondary market. But before that, understand there is something called as capital market or money market. So what are these capital markets? Okay, and money markets. Let us try to understand them. So when we talk about money market, it refers to the market in which borrowing and lending of short-term funds against short-term credit instruments happen or takes place. So such kind of transactions which happen is called as a money market. For example, bill of exchange. What is this bill of exchange? Bill of exchange or BOE is a kind of an instrument which is involved in especially foreign exchange, in export import businesses. Let us say one person has ordered some raw materials from Africa. Okay, and a bill of exchange is instrument which is being issued there because what happens, the African company may not be able to fulfill the requirement immediately. It will take the to 1 month to send the shipment to India. So till that 1 month, what happens is you cannot pay that money well in advance to him. But at the same time, he also has a worry. If I send my raw materials after that, the Indian company does not pay me, then what? So in this kind of a trust problem, this bill of exchange comes into picture, where the latter one, that is the Indian company, will tie up with some bank, and from there they will take a bill of exchange. Okay, so here what happens is this African company is issued with that bill of exchange, and there let us take that the target is to reach to start the shipment on 1st of October. So he releases the shipment, and shipping means it will take 20 days or 30 days to come and reach India. Till 30 days, the African company does not want to wait for its money, and Indian company does not want to pay the money till it receives the goods, that is raw materials. So what to do now in this situation? So here also risk, there also risk. So in this case, what the African company will do is, whatever the bill of exchange was given to him, he will go and give it in his bank. Okay, he will go and give that bill of exchange in his bank, and against it he will take the money from his bank. But you must be thinking, madam, then what about the bank? Is he supposed to repay that loan or something like that? No. Later, once the consignment reaches India, the Indian company will be paying the amount. That time, the African bank will take that amount. Okay. But what is the benefit of this for the bank? Yes, there is a benefit for it, wherein if the money is of 1 lakh rupees, the bill of exchange worth is 1 lakh rupees, the African bank will only give 90,000 rupees for the African company. That 10,000 rupees it will keep as commission for itself. I'm just taking an hypothetical example. The percentage changes there. So 10,000 rupees is what it earns in this bill of exchange process. Okay, but later when the Indian company pays the money, it will get 1 lakh rupees. The bank will get 1 lakh rupees against that bill of exchange. So this kind of a system, a kind of a short-term funding system, what we call, it normally happens in this money market. So there are two categories here, primary and secondary. especially when the first time business is happening between two companies and exchange of funds or exchange of raw materials is happening, we can just call it as a primary. When it comes to a repeat order or something like that, we can call it as a secondary here. The same way capital market also. So here long-term funds are being raised using these individual investors or institutional investors, especially for industrial and commercial undertakings. So huge money is needed for industrial and commercial purposes. So there long-term funds are needed. And big institutions or big individual investors are there who can provide this long-term funding for the companies. This kind of long-term funding happens in capital market. So under capital market also we have two categories, that is primary and secondary. Let us say like around 10-12 years back, VRL went for public offerings. That is, they launched shares. So if the company is launching the shares first time and individuals or institutional investors are buying the shares for the first time, it happens in primary market. But now we have kindly mute. Now, sorry. Okay. First time when shares are being sold, that happens in primary market. And secondary means, as the name itself tells you, second time or third time somebody is buying the shares in the market. So that kind of market is called secondary market. So the best example is VRL around 10 years back went for IPO, where they introduced shares. They launched the shares of the company for raising investments. So that was a primary market. The reason was first time the shares were being sold in the market. Secondary means your Nifty, your BSE, Sensex, wherever you do share tradings, no, that is called as a secondary market, because it is a kind of a like today you buy shares, again sell it, tomorrow you buy another shares, you sell it, right? So this process happens normally in the secondary market. So these are two major parts of the financial market. Yes. When we talk about these financial institutions, banking comes into picture. Okay, so this is where our subject is more interested into, right? So when we try to see here the classification of this financial system, financial institutions here you can see. Okay, so these financial institutions include banking institutions as well as non-banking institutions. So we have these, this is the area which we will be interested and discussing thoroughly in this subject, that is banking institutions. So these banking institutions are divided into four categories. We already know it: commercial banks, cooperative banks, regional rural banks, and foreign banks. Under commercial, we have private and public sector banks also. Okay, non-banking institutions, I can give an example, are these are indigenous bankers, okay, private finances and all, no? So those people come under non-banking institutions. So I was talking about financial markets. We have organized and unorganized sectors. Basically, normally whatever you people will be discussing in investment management subject and all, it will be more related to organized sector. Then we have financial assets or instruments. So these instruments basically are your shares, debentures, all those things come into picture here. So debt, this equity shares, debentures, right? All these things come into picture here. So financial instruments, without which the companies cannot raise capital money or for even investment, working capital, or even for investment also. So instruments are launched into the market wherein they raise funds and they will be using those funds for the development of the companies. Then we have these financial services, fund-based and fee-based. Fund-based means you will fund the project itself. Okay, let us say there is a company which wants to start up a which wants to buy some this factory. Okay, so it will ask the financial service company to invest in that business. Okay, so that is fund based, you are funding them. Fee based is you are giving guidelines, suggestions, decision making, problem solving facilities for them. In terms of credit rating is one such example, which is fee based service. There are credit rating agencies. You all people know about CIBIL score, right? CRISIL, CIBIL score, CARE. These are some agencies who rate the companies, and based on that ratings, the investors will think of investing in that company. Okay, but for these credit rating agencies, they will charge a certain fees for the companies and rate them. Okay, so based on that rating, they will get the finance, they will get the investors without any difficulty. If the rating is low, obviously you will not be getting any funds from anybody. People will not be interested in investing in your company. So it is always said you have to maintain your CIBIL score even in the banks also, right? So if your CIBIL score is not proper, it is below 600 or something, loans are normally not given by the banks. So to improve, to understand the worth of that company, worth of the person, worth of the business, sometimes I'll tell you guys, credit rating is all even done for state, countries also. Okay, so for example, if a big Indian company like Tata wants to invest in Cambodia, okay, the country Cambodia is being rated by certain agencies, whether it is suitable to invest, whether you will be you will be getting good returns, whether there is any risk of investment, right? By seeing all these factors, they will rate that country, and based on that rating, the Tata company will decide whether to invest in that country or not. These are all fee based services. So we are not interested in these three parts now, right? So we are more interested in financial institutions. So that is our main motto for the subject banking and financial services. Yes. So this is what is financial institutions. As I was talking about, banks, non-banking activities like indigenous bankers and all, you know, all those come under these financial institutions. So let us not discuss the informal part now, that is indigenous bankers. Let us discuss about the formal banking system of our country. Why actually it is needed for our country? The basic major reason is it helps you to achieve the economies of scale. So now you people have studied economy. So kindly tell me, what is this economies of scale? Any one of you?
Ma'am, enjoy the benefit of two companies, reduction in the cost and
Nandan, it is not audible clearly, Baba.
Ma'am, by producing in bulk quantity, we can reduce the cost of the total production.
Yes, very good. It is, yes, as she told. Who is that?
Ma'am, Vaishnavi.
Vaishnavi, very good, Vaishnavi. Yes, financial institutions are the ones which actually carry out the investment and other activities in large scale quantity. Okay, so in terms of pooling the funds, in terms of investing that huge amount into industrial setup, ultimately, which can help the country to achieve that economies of scale here. See, an individual person cannot invest huge amount in project. Sorry, anybody? Okay, so an individual investor may not be able to pool such huge funds and invest in projects or industries. So here, these financial institutions, what they are doing, they are pooling the funds, right? People like us, we go and deposit money in the banks. Okay, like this, there are lakhs together of customers for them who will deposit money for the banks. So that amount, huge amount, is being used up for developmental purposes, ultimately to achieve the economy of scales. So that is one biggest benefit you get out of financial institutions. Second is you will get is lower transaction cost. So what happens, because of the economy of scale, the cost of each transaction will be much lower. When we talk about production unit economies of scale, you know, instead of manufacturing 10 units, if you start manufacturing 50 units, ultimately the cost of production will always come down, right? Let us hope. How many of you have seen this Parle factory in Hubli?
Ma'am, everyone, ma'am.
You had been, no, there?
We have visited from. Yes, ma'am.
Okay, good. So you know that Parle factory has a capacity, I guess, of around 80 ton per day. Okay, so but it manufactures hardly 20 or 30, sorry, 30% of the production. So if even though its production can produce around 80 tons per day, but still it is producing 30 or 40 tons, means it is not performing on the economies of scale. That is, it is not using its assets or the machines fully. But when you talk about economies of scale in industrial setup, you should be able to use the maximum capacity of that asset, of that factory. Then only you'll be able to achieve that lower transaction cost here. So that is what I was talking about, because the economies of scale, the cost of each transaction will be much lower than what it would have really been. So if those transactions are carried out by individual investors on their own, it would be really difficult for them. Okay, even for the company also, even for the individuals also, they have to understand the company, they have to understand the business, they have to understand whether it is safe to invest and all. So it is a really bigger headache for the individual investors. Here what happens, the big financial institutions, so-called banks, will do all the work, pool the funds from individuals, and then they think of investing in those businesses or projects, due to which whatever procedures or amount is involved, right, all that operating cost and all can be reduced drastically. So that is why they call it as lower transaction cost. That is one more benefit by financial institutions. The third benefit is diversification. So as these financial institutions are dealing with huge amount of pooling or funds, they diversify their investment in such a way that risk will be less. Guys, keep in mind, if today automobile sector is growing really good, if everybody starts investing in automobile sector, obviously maybe there is a day where automobile sector may collapse also. At that time, whatever you had invested in automobile sector, you will be losing it. So here, what these financial systems, sorry, institutions will do is they diversify the funds. They just not concentrate only on one area. Some amount, because ultimately banks operate on depositors' money. Okay, it is the money of our we common people. So the banks cannot risk that money and invest in only one or two businesses. And if those businesses end up, they will be the one who are going to face the repercussions. So that is why what they do is these financial institutions, they will diversify the funds and then invest in different areas, so that the risk somewhere is reduced, right? So they will invest in shares, they will invest in debentures, they will invest in projects, they will invest in government projects, they will invest in SMEs, right? So like this, diversified investments can be easily done by these financial institutions to somewhere reduce the risk being involved in case if the investment happens only in one or two areas. So that is what is one more benefit you are going to get. So we all people invest in mutual funds. what ultimately happens? You go and invest in a bank, and those banks will invest in some mutual funds. For let us take like the worth of a particular investment is 1 crore. I cannot go and invest 1 crore rupees because I don't have. Right? Instead, what I will do, I will invest hardly 20,000 rupees. Like me, there are hundreds of people who wish to invest. So the bank will do what? It will pool the funds from the individual investors. He himself will go and invest in these bigger projects. So that is what is the way these financial institutions will be working. So I was the same thing I was talking about. So this is the area which we are, sorry, commercial banks. Okay, these are the area. This is the major part of our subject, that is commercial banks. So this is what we are going to discuss from now onwards. Now, till now, any doubts? Yes, any doubts? Okay, shall I go ahead a bit?
Yes, ma'am.
Yes, I was talking about these financial services. I'll just give you some few more examples here. Like equipment, that leasing is there, no? What happens is the banks will lease a big, huge equipment for an industry or for a company. If the company does not want to buy that machine, which is very costly, what happens is the bank will buy on behalf of the company, and that machine is given to the company to be used. For this, a rent is being fixed up, and every month or 6 months or yearly, whatever are the terms and conditions, the company will be giving that rent to the bank. That is what is leasing. Okay, so like this, many things are done: factoring, credit rating. These are some things which we will be discussing in detail in the coming classes. So that is why I'm not touching them in detail. Venture capital services, securitization of debt services, factoring, housing finance, hire purchase. We have equipment leasing, we have issue management, we have merchant banking. All these things are financial services, which will be the last part of your syllabus, which we are going to discuss, right? So till now, hope if you have any doubts, you can just highlight. Otherwise, I will go to the next topic, that is reforms in Indian financial systems. Okay, fine. So I'll ask you one question today. How many of you have heard this word CRR, SLR, repo, reverse repo? Have you heard that?
Yes, ma'am.
Yes. Okay.
Yes,
Do you
ma'am.
understand what are these terms? Anybody?
Reserve Bank.
What is CRR? What is CRR?
Cash
Credit
reserve
reserve
ratio.
Reserve ratio.
Very good.
Cash reserve ratio, ma'am.
Correct. Very good. What is
Cash
this
reserve
cash
ratio?
Okay, cash reserve ratio. But what is this cash reserve ratio? Hello? Hello?
Banks
The percentage of cash
Ma'am,
will be
bank
kept in the
has
form
to-
of reserves.
Yes. Where?
In
Ma'am,
bank.
Yes, very good. Okay, certain percentage of the amount being collected by the
10%.
depositors, it changes. Okay, if you just visit a RBI website, you will get what is the CRR and SLR rates as of today. Okay, so it is a kind of a money which is being kept as a reserve with RBI. Okay, so it normally ranges from 4% to 6% normally. So that is CRR ratio. And what is SLR?
Statutory liquidity ratio,
Statutory
ma'am.
liquidity ratio.
What is that?
The bank has to compulsory put some percentage
Other
of
banks
treasury
gives
The bank has to.
same RBI bank also
Hmm.
Banks
The
are
bank should
banks are
reserve in
put
liquidity
some
form.
liquid assets, ma'am.
Okay.
The
So.
gold.
Security.
Yes, fine. So what happens is this SLR, that is statutory liquidity ratio. As the name itself tells you, statutory means it's a compulsory reserve which is supposed to be maintained by the banks at any point of time. Okay, so you cannot say a big businessman ಬಂದಿದ್ದ ಅವನಿಗೆ ನಾವು ಬಹಳಷ್ಟು ಲೋನ್ ಕೊಟ್ವಿ ಅದಕ್ಕೆ ಅಮೌಂಟ್ ಖಾಲಿ ಆಗೈತಿ ನಾಳೆ ಇಮಿಡಿಯೇಟ್ಲಿ ಅದನ್ನ ಫುಲ್ಫಿಲ್ ಮಾಡ್ತೀವಿ. No. At night 1 o'clock also, if RBI officials come and visit your banks, you should maintain the SLR ratio. Okay, that is what is statutory liquidity ratio. As of today, the CRR, that is cash reserve ratio, which has to be maintained with RBI, is 3%. Actually, it was 4% last year. Due to this COVID situation here, it is normally between 3.5 to 4%, but now it is 3% as on today. Fine. The SLR ratio, sometimes it has gone up to 23-24% also, but right now present SLR ratio is 18%. So whatever deposits you have, out of that 18% has to be kept as statutory liquidity ratio, has to be kept as a reserve, and 3% has to be deposited with the RBI in a current account on which no interest is being paid. Okay, so this is what is CRR and SLR, which has to be maintained with according to the norms of RBI. There is something called as repo rate and reverse repo rate. What is this?
Percentage of interest charged by RBI to the other banks.
What is repo?
Deposits.
What is repo rate?
Repo rate is the interest rate on which the RBI give loan.
Very good. So repo rate is the rate of interest which is charged by RBI when it gives loans to the banks. Okay, when it gives loans to the bank, it charges some rate of interest, and that rate of interest is called repo rate. But the bank has excess funds and it is not using it, so it wants to deposit safely with the RBI. Okay, if the bank goes and deposits the money with RBI and some interest is given on that amount, that is called as reverse repo rate. Okay, so repo rate as of today is 4% and reverse repo rate as of today is 3.35%. So if you go and keep a deposit, you will be only getting 3.35%. So the class will be closing in a minute. Join immediately with new meeting. Okay, the same code and password.
okay, ma'am.
Okay, ma'am.